Want to know the difference between one $20 bill and $21 bills? It's absolutely nothing. You might have noticed that there are a lot of stock splits happening lately. Tesla, Amazon, Google parent Alphabet, GameStop, and Shopify have all announced plans for stock splits in 2022. So what is a stock split and how does it affect your investment? The textbook definition of a stock split is when a company splits each existing share into multiple new shares. If a company splits 2-for-1, the share price will be cut in half, but the amount of shares outstanding will double. Firms usually do stock splits when a share price has increased substantially. The split brings down the price of the stock, making it more affordable, which attracts a wider range of buyers. Now, the important thing to remember is that a stock split does not change the overall value of your holdings or the market capitalization of a company. To illustrate, come join me in the IBD break room and let's pretend that this delicious pizza is equivalent to one share of company X. Now, say company X wants to do an 8-for-1 split. That would mean that this pie gets cut into 8 equal pieces. Now notice that the overall value didn't change, but there's now more slices at a much lower price to go around. Now again, stock splits do not change the value of a company. As an investor, the value of your holdings will also be the same amount after a stock split. You'll just own more shares. If you own fractional shares of a company, the same idea applies. So let's say you own half of a share of a company. If there's a 2-for-1 stock split, your holdings double, so you now own a whole share of that stock. Now, what if you own a stock that pays dividends? Usually any dividends after a stock split will also be reduced proportionally per share to account for the increase in shares outstanding. This leaves total dividend payments unaffected. Now, let's say you have a call option on a stock and then a split is announced. What happens next? Well, if you hold an options contract of a split stock, your contract will be recalculated so that it's not affected by the split. It'll show the new price and number of shares, but the overall value will not change. This is known as the process of being made whole. So if we go to our 2-for-1 split example, an option contract that covered 100 shares with a strike price of $100 each would now cover 200 shares with a strike price of $50 each. Companies that are in financial trouble will often announce a reverse stock split to prop up the share price and avoid delisting. So a company trading at $5 per share can initiate a 1-for-2 reverse split, resulting in a $10 share price. If the company had 100 million shares outstanding, that number would drop to 50 million. We crunched some numbers with our sister company Dow Jones and found that between 2012 and 2021, stocks in the S&P 500 rose roughly 12% on average in the year following their stock splits. And rates of stock splitting are up over the last few years to some of their highest levels in roughly a decade. Excessive stock splitting has been seen at market tops in the past, especially when tech stocks topped in 2000. Now, for example, Qualcomm had a 2-for-1 stock split in May 1999 and then declared a 4-for-1 stock split in December of 1999. Stock splits can be really tempting for investors because it allows them to buy what was a previously more expensive stock at a much cheaper price. But guess what? You should never buy a stock just because of a stock split. Make sure you do your homework, check stock charts for the right time to buy, and focus on firms with top fundamentals that are leading price performers in their industry group.